you all to kindly rise for the terror attack and to offer our prayers for the innocent lives.
सुप्तेषु जाग्रति एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमानः तदेव शुक्लं तद्ब्रह्मा
Thank you, members. And we all pray that terrorism is eliminated not only in India but the whole world. Now, coming to the subject proper, we have our first speaker, CA Yogesh R Amal, who will take us through financial statements for non-corporates and issues in CARO. So, I request our committee member, core committee members, CA Viral, to briefly introduce him.
Good evening, everyone. Pleasant task today to introduce our speaker, who's been a regular speaker at our forums, CA Yogesh R Amal. He is a commerce graduate from the Mumbai University and a fellow member of the Institute of Chartered Accountants of India. He qualified in the year 2001 and is in practice since then. He is currently a partner at GBCA and Associates LLP. He has been instrumental in his firm's foray into business support services and outsourced CFO practice, and is experienced in managing audits of large corporates including listed companies, multinational companies, and PSUs under various ERP environments. His area of expertise expands to providing accounting advisory services and his experience in Indian GAAP, Ind AS, and IFRS. He has delivered talks at various seminars for professionals on tax audit, standards of account auditing, Schedule 3, CARO, etc. Currently, he is serving as the Vice Chairman of Accounting and Auditing Committee at Chamber of Tax Consultants. In addition to contributions in various journals, he has also co-authored for following publications: BCS publication reporting under new format Informed PCD, WIRC publication for anthology on Ind AS notes and disclosures, CTC jointly with Taxman publication on comprehensive guide on CARO 2020. He has also contributed by drafting 4 social audit standards out of the 16 prevailing standards, which shall be followed by all the social auditors while auditing entities listed on social stock exchange. With this brief introduction, we warmly welcome you, sir. I would request CA Vipul Shah to please present a memento on behalf of the entire study circle. I would request CA Nilesh Vasa to present CABF receipt of rupees 500 to Yogesh sir. Thank you. The stage is all yours, sir.
Good evening, friends. Thank you, Viral, for this nice introduction. Thank you, Vipul Bhai, again trusting and giving faith in me and inviting me at the study circle for delivering the talk on financial statements of non-corporate entity. Thank you, members of BCSC, again trusting and allowing me to share the thoughts on this topic per se. So with this brief, let me start the topic directly per se. So today's topic, what we are going to discuss is financial statements of non-corporate entity, and time permitting, I would also take common errors which were identified in CARO reporting. Now this identification of common errors I have picked up from FRRB publication. So these are the common errors which are actually in public domain, and those, mind you, those are for large listed entities, because those are the entities where FRRB generally picks up for their review. So this would be the broad agenda for our today's discussion. Starting with, first I would deal with financial statements of non-corporate entity. Now while this topic is not new, we have discussed time and again earlier. Also, there is not much this is not like कुछ हवा में से एकदम आ गया है. We have been doing this for all these years. We know everything. It is just that I have compiled all my thoughts at one place, and we as a team are discussing here. What I would appreciate is the topic is such that we would have an interactive session wherein I will share my thoughts. I would expect some thoughts from you. I would expect some queries from you, which I would try to address if I have the answers, or if there are some queries, I would discuss with you and we'll try to come up with some solution practically. Let me acknowledge and congratulate BCSE to keeping this topic on a very timely basis. Now that the season of audit has started, all of us definitely do have a lot of non-corporate entities, and hence this becomes relevant. Another reason why this becomes very relevant at this point of time is because from 1st April 2024, this has become mandatory, meaning any financials prepared from 1st April 24 to 31st March 25, we will have to follow this as a mandate. Though it talks of guidance note, the name is guidance note, but we all understand the guidance note for us as a member is mandatory to apply, and we have no choice but to apply. So little brief or history, then why this 1st April 24 becomes relevant and why not earlier? So if you remember, earlier it was a technical guide and not a guidance note. Hence, technical guide did not have that value which a guidance note would have, and therefore this becomes more important from this year so as compared to earlier years. So this was a brief and background about why this implementation now. What is the objective? Now we all have been doing the audit of non-corporate financials, non-corporate entities. We all know what kind of format we had been using, what kind of information which we had been reporting, what kind of disclosures we had been making. Now that was becoming really difficult, wherein there was no consistency in reporting the data. There was no comparable data available. At the same time, there were no transparencies in reporting the information. When I say transparency, all of us know these days transactions with related parties is very key. Now, so far, barring few entities, I have not seen any entity reporting related party transaction when it comes to non-corporate. So there was actually no transparency in reporting. Therefore, there was a need which institute thought that there should be some guidance or some literature available where people can apply this so the data becomes comparable, transparent and complete. So this was the primary objective. In addition to this, also the standardization. I have seen financial statements in T form. I have seen financial statements in vertical form. I have seen financial statements not having comparatives or previous year figures. Now, comparative or previous year figures, irrespective of whether this guidance note was there or not, in my view, it was always mandatory, because by way of standard of auditing, we as in chartered accountant had to report data which was comparable. Otherwise, your financial statements does not become true and fair view. So, all those practices were followed wide across. Hence, there was a need that there should be a standard format where everyone reads the financial statement as is in the same lines as we already do for corporate entities. So since we are doing corporate entities for long, this is not new again. It is just that for non-corporate entities, we'll have to change our mindset. And the biggest mindset change will be required by the auditees, because so far they would not be used to these kind of questions which as an auditor we would ask. So that is a major mindset shift which we need to prepare our auditees now onwards, so that we are, as I said, it was very timely session, so that we can start preparing themselves, and a lot of pressure which can be avoided while we are doing those audits in the month of August, September, so on and so forth. So as I said, since these are the financial statements which will be in the standardized format, what will happen is there are various stakeholders to these financial statements. There could be bankers, there could be authorities, income tax department, GST department, so many other departments. They would also have the details properly compiled in the format. Hence, this would be in the interest of even stakeholders that we share the information in this standard format, which enables us to take the right economic decision, which could be mainly for the bankers, because there are a lot of entities who would have borrowed from the banks. So this is the brief objective why this guidance note was introduced. Now, who are non-corporate entities? In one line or in summary, any entity which is not registered under Companies Act in general is a non-corporate entity. So companies and LLP, why I am saying LLP right now, because there is also a guidance note which is driving the standardization on LLP, which is almost similar what we would be talking. So there is hardly any difference between LLP and non-corporate entity, but yeah, there are two literatures issued already by the institute. So any entities which are not corporate in general would be non-corporate entities, which would include sole proprietor, which would include HUF, partnership firm, trust, society, AOP, BOI, or any other body. So all of these entities will have to follow this guidance note, prepare their financials in accordance with this guidance note. Now, there is a caveat here. What if there is an entity which is a non-corporate entity and there are formats prescribed under the respective act or respective statute? Example, trust. Now, in case of trust, Bombay Trust Act defines the format. Now, in those cases, the trust may not follow this format and follow the trust which is prescribed by the respective act. Similarly, there could be many other agencies, like the banks also. Technically, there would not be any bank which is a non-corporate, but assuming there is a bank which is a non-corporate entity, or an electricity company, or an insurance company, or society. Now, all those respective acts gives the standard template or format in which the financial information has to be prepared. Therefore, to those entities, these templates or formats is not applicable, which one should keep in mind. So what happens to typically a private trust? While the charitable trust may have the exemption of not following this template, but private trust, which generally is not registered with the Charitable Trust Act, will have to follow these templates. And I have seen there are many private trusts who are not registered, so yes, those templates will be applicable to them as well. In fact, there are many private trusts who are in the corporate form, so those entities follow Schedule 3 template for their reporting purpose. Broadly, these non-corporate entities are segregated or classified into 4 levels, level 1, 2, 3, 4. Largely, level 1 would be large size entities, level 2 will be medium, level 3 would be small, and level 4 would be micro. So this is the broad classification when it comes to non-corporate entities. So we call level 1 as large, and all other 3 entities, level 2, 3, 4 is MSME broadly. So this is the broad classification as far as level of entities is concerned. So yeah, this is overview. As I said, the ICAI has issued the guidance note along with the format. However, if relevant statute applicable to non-corporate entity, I did discuss this. Okay. So whatever disclosure requirement mentioned in this format or a guidance note are in addition to the disclosure prescribed by the accounting standards. Meaning, if you want to give any further classification or further details or further disclosures, this template is not sacrosanct. This is kind of a minimum disclosure requirement. You may disclose more if you want.
चेंज करके देखो अमर चेंज करके देखो स्क्रॉल डाउन
I think let's continue. Not very much. You will already get the copy of this presentation. So, as I was saying, this is the minimum set of disclosure which is expected. However, if you want to add any few line items for a better governance or for better transparency, definitely you can do that. And you cannot restrict yourself. So you cannot restrict yourself. I mean, one can give more disclosures as one wants to. One more important which we will have to keep in mind while we prepare these financial statements is, like we do for corporate entities, we will have to also cross-reference all the notes and all the disclosures along with your balance sheet and P&L. This is something in addition to what we will have to keep in mind. Comparative figures, we did discuss that comparative figures are mandatory, and it was otherwise also, but so far we had not been reporting, so it is a key item which one should keep in mind while we are preparing this financial statement. Now, whether these financial statements can be rounded off or not, as we do for corporate entities, yes, these financial statements can be rounded off, which the threshold is total income less than 100 crore, then it could be 100,000 lakhs or millions, and if the total income is more than 100 crores, then the lakhs, millions or crores. Now, as far as corporate entity is concerned, it is mandatory to do the rounding off. When it comes to non-corporate entity, it is not mandatory, so one has got option if one wants to round off. These are the rounding facilities which are available. If your total income is less than 100 or more than 100, you do the necessary rounding.
Sir, since comparative statement is mandatory, so we have to convert previous year's balance sheet also into the new format?
Yes. So when it came to rounding off, once you have decided that you will use one unit of measurement, say hundreds or say thousands or whatever, then we'll have to ensure that all the disclosure notes, textual notes, there also the same rounding off or same unit of measurement has been considered for reporting purpose. This guidance note is applicable from 1st April 24, so any audits we will, for this season, this financial year which we would sign, we will have to follow this guidance note. And this model is only and only relevant for non-corporate entities and not any other entities. One quick question can come is whether this template or this format is applicable to the entities who follow Ind AS. Now there is a possibility that some non-corporate entity must be following Ind AS for XYZ reason, because their holding or those could be their subsidiaries would be part of Ind AS. So if they are preparing their accounts as being a non-corporate entity, then this template would not be applicable, and they will have to follow the respective Ind AS template, which is part of Schedule 3, Division 2. So this time the guidance note has gone into define in detail even what are financial statements. In an ordinary course, when we talk what is financial statements, we say profit loss balance sheet. Now profit loss balance sheet, yes, those are part of financial statements, but guidance note categorically says that profit and loss statement. So basically it talks of statement of profit and loss account. Now these are very small things, but we loosely give header to our profit loss account as profit loss account. Now technically that would be wrong. because the financial statement now, the guidance note says that financial statement includes statement of profit and loss account and not profit and loss account. So those kind of small things one will have to keep in mind. So what is financial statement? So financial statement includes balance sheet, statement of profit and loss account, cash flow statement, and notes to accounts. So the moment I say cash flow statements, friends, yes, cash flow statement is also applicable. Of course, you'll have to see which level of entity you are auditing. Depending on the level, this may not apply. But for large entities, for level 1 entities, all accounting standards are applicable as is, and therefore even cash flow statement is applicable to them. Why I'm stressing a little more on cash flow statement is so far we have never made cash flow statements for non-corporate entity, and would be really difficult and challenging to convince client that they have to make cash flow statements and give it to us for our audit purpose. So this is one major shift or major change. Notes to accounts. Now, how many of us have reported notes to accounts the way it ought to be? Typically, I have seen for non-corporate entities, notes to accounts 2, 3, 4 लाइन या 4 पैरा में खत्म हो जाता है. That will not work now. You'll have to literally write all accounting policies the way you ought to report in the corporate entities. Similarly, all disclosures, all noting or textual disclosures which would be required, those also are required for non-corporate entities. So this is defined in guidance note. What are financial statements? Let me run through the format of financial statement which guidance note prescribes. So otherwise it is a typical vertical format which one would prepare. However, one needs to be careful in few line items. When you see the template or format, starting thing it says is owner's fund. Now owner funds is further divided into 2 parts: owner's capital account and reserves and surplus. Owner's capital account is further divided into capital account and current account. Now, how many of us so far were reporting current account as a part of capital account? There were multiple practices for multiple reasons. I have seen some balance sheets where current account is reported in other current assets or other current liability, the way may it be. So these are the kind of practices which were followed. Now with these kind of templates, this is going to be streamlined. Now the point here is capital and current. Now there are firms who are maintaining drawing accounts also separately. What do you do in that case? The template only says capital or current. My view is it still will get clubbed under owner's fund. We will have to insert one more line, drawing accounts, because in principle, in substance, those are capital accounts. Those are segregated separately for XYZ reasons. Now, if you really don't want to show this as a part of owner's fund, some amount, then there is a possibility that one may show it or reflect it as a loans account. So if that is a partner's loans account, then definitely it will take the color of loan, because those loans will have a different conditions or terms attached to that transaction, which may bear interest, may not bear interest, so on and so forth. So in my view, partner's loan will not be part of owner's fund, and it has to be reported under borrowings if it is loan given, and if it is to be reported under loans and advance asset side if the loan is given. So this is one small, this was about capital account. Coming to reserves and surplus. Now again, I have not seen, or rather I have hardly seen any entities who would classify reserves and surplus in a non-corporate entity, practically. But yes, there is a concept. There is a possibility that the deed may not support to transfer. Typically, all the profits earned during the period are transferred to the capital account. But there is a high possibility that deed may say that all the profits are not distributable and one will have to park in reserves and surplus or profit loss credit balance. Therefore, this line has been considered, and in my view, yes, rightly so, this has to be reported separately. The moment we talk of reserves and surplus, the second immediate thing which comes in my mind is the movement. So assuming there is a profit loss during the year and deed says, say 50% of profit should be distributed to capital and balance 50% will go to the reserves and surplus. Then what does one report here? 50% only net, or 100 first transferred to P&L and then out of 150 transferred to capital account and then net 50? So in my view, yes, the moment there is a reserve, if all the movements will have to be shown. So at first place, from profit and loss account, one will have to transfer the amount to reserves and surplus. From there, one will have to transfer then to capital account. This gives another clue that now all the movements in the capital account also will have to be reported. Like, I'm skipping one slide. Like this. So opening balance, capital introduced, withdrawal, remuneration, interest, so share of profit, so on and so forth. So whole movement particular wise will have to be reported and will be part of this format. So as you can see, it says owner fund, reserves and surplus, then non-current liabilities, then current liabilities. This is liabilities side. And if you go to asset, non-current assets, and current assets. Now this again brings into a big challenge the classification of all the transactions between current and non-current. I'm not sure so far whether ever we have reported for any non-corporate entity and whether clients are really maintaining the data such. Therefore, again there will be a big challenge to compile these kind of line items for the entities, and it's right time now that we talk to our clients, share this information or template with them that yes, this is what is expected and this is what is to be reported. The immediate challenge or the feedback which client would definitely come up, we would come to accounting standards where we say that all the accounting standards are applicable. I'm sure most of our clients are going to come back and say that whether accounting standards are applicable to them or no. What is the authority through which those becomes applicable to them? There is no clear answer. Even I don't have. Anyone here if can support me. But yes, those are applicable and definitely those are applicable to us as a member. And if we are auditing any entity which are not complying with accounting standard, it is our responsibility to report whether the accounts are in compliance with those accounting standard frameworks or not. So I have the current assets and current liabilities. I'm sure current assets and current liabilities, all of us are very clear what is current assets and what is current liability, but just for the sake of discussing, in general, anything, the normal, without digitized kind of thing, 12 months is the period which one would consider for current assets or current liabilities. But if the business is such which may warrant the longer or a shorter working capital cycle, in that case the current assets and current liabilities would be different. So assuming construction project, which typically gets completed in 3 years. For that entity, the current assets or current liabilities classification will be 3 years and not 12 months, is something that one should keep in mind. And this would be equally applicable to all the transactions. Now, I've seen some errors happening there as well. Borrowings, typically we have a mentality कि next एक साल में मेरे को term loan repay करना है, तो we will show it as a current liability. But no, if your operating cycle is different, if your current operating cycle period is different than 12 months, you have to keep those period in mind for reporting all your assets and all your liabilities, may it be borrowing or any other asset. This is something which one should keep in mind. So we are on non-current, long-term borrowings, short-term borrowings we are used to. Trade payables. So here as well, as we have it for corporate entities, these trade payables will have to be segregated between MSME and otherwise, and the reportings are required similar to the corporate entities which we have, which again will be a challenge because I don't know how many non-corporate entities would be maintaining data that way. The biggest problem, fixed assets or PPE. I have seen very few balance sheet again where the PPE disclosures are as required by this guidance note, meaning the similar disclosures which we make for corporate entity where you need to have cross block, all the movements of additions, deletions, all the movements of depreciation, so depreciation block, opening, addition, deletion, closing. Now very rarely people are maintaining this way. Otherwise I have seen for all practical purpose, depreciation in non-corporate entities is charged at income tax rates. No gross block, no net block is maintained. Simply WDV are maintained as required by Income Tax Act. Now in such scenario, what do? There are big problems. Apparently, if the gross block and net block is not reported, in my view, AS10 is not complied. In my view, accounting standard is not complied. In my view, there would be a qualification. However, one will have to be a little practical as well, that if somebody really wants to maintain this, but where would you get the data from? Typically, historically, this data is never maintained. So what do? So maybe for all practical purpose, in my view, you may go 4, 5, 6 years backwards, pick up all the additions, create a cross block, whatever cutoff date you have taken, say hypothetically 1st April 21, say in your disclosure that WDV as on 1st April 21 is considered as gross block for that purpose, add all those additions later and start working like this. But this does not solve the problem. This does not solve the problem for earlier assets, because typically in accounting standards, when the asset is sold, you have to book the profit or loss on sale of assets, for which you need to know cost, for which you need to know accumulated depreciation. For all the earlier assets, we don't have this information because the client would have never maintained the fixed asset register, which would give the breakup asset on line basis. So practically, again, there would be some non-compliances there as well. One will have to try and do some practical approach, try to find out some data. I think that is the best one can do. But I'm sure for maybe next 1 or 2 years, definitely all of us in our audit report will have these kind of disclosures saying something or otherwise is not complied with because the entity has started following this now onwards. So fixed asset could be a big pain as far as this audit season is concerned. Any questions on fixed assets?
Most of the proprietary concerns have a combined personal balance sheet with it. So how to
So typically, I would always say that as an auditor, assuming, are you comfortable signing personal assets as well? So what do you do otherwise? So all the business assets have to be segregated. There should be separate balance sheet when it comes to business. That's what practice we follow. If, assuming this is the first year or maybe second, third, fourth year of the SSC, and if I'm supposed to do the audit, I would definitely ask SSC to create two separate balance sheets. One would be business balance sheet and one would be personal balance sheet. Of course, there will be few challenges, assuming that there is only one bank account. Where do you record that bank account? So one will have to see what the actual facts are, but assuming one bank account, largely the transactions are business, I would keep it in business books. All the personal transactions I would route it through capital account, or otherwise if largely the transactions are personal, then I will keep it in personal balance sheet, and all other transactions I will route it through capital account. So some workaround will have to be done, but I as an auditor would not want to audit personal balance sheet of any SSC. That is not my job. That is what I'm not supposed to. Yeah, please.
It is depreciation provided on straight line basis in books.
That's fine.
Then
That's fine.
that can be done.
So what does AS 10 says? That you have to provide depreciation on useful life concept. So it doesn't say WDV or SLM. It says provide basis useful life, and you can have a choice of yours. What is the best way to represent your financials? So if it is SLM, then definitely SLM. If it is WD, then definitely WD. If there is some other method, now say many manufacturing concerns do provide depreciation based on the production basis. Like there is a machine who can only produce 100 units, and if 500 units are produced, then 500 to the extent of 500 units, the depreciation will be provided. So any rational method or any logical method which you can, yes, that should be okay. So SLM WDV is not a challenge as far as books is concerned.
We can take rates as well, income tax, and we can maintain the gross profit as well.
Yes, you can. So rates, see, AS10 does not give you rate. It simply says that you have to amortize or you have to provide depreciation basis useful life. Useful life basis the income tax rate you can determine, but of course there has to be some logic to it. It cannot be random, because AS10 says you provide, typically in case of corporate entities, it says either you take the scheduled rates, schedule 2 useful life, or if you have any other useful life, then those should be technically justified by technical people. So if you have some logical reasonings, back up why you have to consider a specific useful life, then there is no harm.
Sir, as you said, people are charging as per income tax depreciation. So how to get that values? If it is 10 year back, assets is purchased.
I completely appreciate it. That's the reason I said this is one topic which is going to literally break our head, because fixed asset को आपको उस format में लाना है. So you have to take some practical view, as I said. Maybe go back 5-6 years, at least उतना data तो right pull करो, उतना तो easily available रहेगा. उसके आगे का call लेके keep reporting in your accounts. That is the only possibility which I can practically see. It is difficult, but that's what I'm saying. See, you will have additions available in all your tax returns. So you know, last 6 years का तो SSC के पास books of accounts रहेगा, vouchers रहेगा, सब कुछ रहेगा. So take some practical call and work little backwards. Yes, yes. And this is not going to be easy. Now, all of us know how non-corporate entity functions, क्या उनके staff strength, actually ये काम कौन करता है. So, precisely, that is going to happen practically. So you'll have to be prepared mentally now that these are some areas where you'll have to devise your strategy at your firm, depending on what kind of client profile you have, and you'll have to approach accordingly. But कोई yes and no answer नहीं है इसका. Problem है, पहले से लोग ऐसे ही maintain करते आ रहे हैं जो गलत था. It was never right. It was never right. But sake of convenience, क्या फर्क पड़ता है?
फाइनेंशियल स्टेटमेंट बनाने की जिम्मेदारी एसएससी की है.
Definitely is.
वो
नहीं बनाता है तो अपना क्या रोल है? Only not like
डिस्क्लेमर और क्या करोगे? और क्या कर सकते हो आप? डिस्क्लेमर on this forum. Yes, that is the best solution. Yes.
simple एक line, only one line.
Only one. Sorry? It is mandatory. So, I'm sure all of us are aware that there are standard of auditings also which are applicable to us as a member irrespective of any entity which we audit, may it be corporate, non-corporate. तो वो सारे स्टैंडर्ड्स को अपने को अदरवाइज भी एप्लीकेबल थे. वो तो बोलता ही था अपने को कि फिक्स एसेट वेरिफिकेशन आपको करना है या फिजिकल वेरिफिकेशन ऑफ इन्वेंट्री भी आपको करना है पीरियडिकली एंड ऑल दोस थिंग्स. तो वो सारी रिस्पॉन्सिबिलिटीज में कोई चेंज नहीं है आज. Everything is as is. Now, unfortunately, for non-corporate entities, since there was no governance required, इतना कोई ऐसा कोई authority नहीं था जो अपने को बोलता था कि ये सब करो, तो चल रहा था. क्योंकि in most of the cases, non-corporate entities, we were only doing audit because tax audit है उसमें. Now that we are on this topic, हम non-corporate entities में audit report क्या issue करते हैं? What kind of audit report are we issuing in general? Form 3CB? Form 3CB? Should I tell you that it is okay that you can also issue another report which is a special purpose financial statement report other than Form 3CB? क्या ये हम digest करेंगे? So very much possible. The way we report LLP audits, LLP audit का अलग report issue करते हैं. Same, you can do that. So, SA 700 series, SA 800 series is giving all this guidance. So even for these entities, I can very well issue a separate audit report, which is probably 800 series, special purpose financial statements. I can still do that. Where? And why I'm saying this? There are questions कि 3CB में qualification कहाँ report करने का? Of course, guidance note says कहाँ report करने का, but if you still find it difficult, you can pick up SA 800 or that special purpose financial statements का audit format. It has given detailed structure, management opinion paragraphs, management responsibility, auditor's responsibility, so on and so forth. Push all your qualifications there. There is no need to do that. You are not engaged. There is no need. You are not engaged to do that. There is no need. I'm just, that's what I said. कितने लोगों को digest होएगा? But there is a possibility. I may want to disclose certain information. Things are going very like but it is not practical. I agree. Otherwise, it is waste of time. Okay. So, we are fixed asset. That is one practical challenge. Yeah. We would generally practically ask even to maintain that balance sheet separately. We would carve out those transactions separately. Form 3CB, there is one para, auditors, comment, observations, so on and so forth. So you have to report there. All your qualifications will take place there. So this is one.
Where the tax audit says that I have to qualify in the accounting standard?
Because see, as a member of institute, accounting standards, it's your responsibility. Institute has said that when you are doing any audit, you have to ensure the compliance of accounting standards, and if those are not compliant, you have to report. These are coming by way of literature from institute.
Whether institute has said where to report?
Yes. Yes. You have to ensure the compliance. So this is one area we will have to break our head. Investments, again, current, non-current, I don't know how many people do investments classification properly, current, non-current, as required by AS 13. सो परमानेंट डिम्यूनेशन का डिटेल्स कहाँ से आएगा, कितना वो मैनेज कर पाएगा, ऑल दोस थिंग्स विल बी अगेन अ चैलेंज व्हेन इट कम्स टू इन्वेस्टमेंट. Deferred tax, big problem again. I don't know how will clients understand really deferred tax in case of non-corporate entities, but yes, we know now, and it is our responsibility to educate client कि deferred tax क्या है और कैसे करना है. So like corporate entities, even here also exceptional items, extraordinary items, discontinuing operations, all those things will have to be reported separately. That is something which one will have to keep in mind. Two specific typical disclosure or additional disclosure which I would say is partners remuneration and partners capital accounts has got a specific place. Those have to be interest on capital and partners remuneration have got a specific place. So those have to be reported independently, separately. Otherwise, we are more or less used to this kind of format.
Sir, there will be some clients who insist that tax audit is not applicable, but it is given for audit. So in that case,
This will be applicable. The moment you are issuing any report,
report will be
any report in any form, then this will be applicable because this is responsibility. I mean, this is coming out of ICAI mandate to you as a member. So any reports issued. So assuming if somebody is getting special purpose financial statements for some other purposes, I would want them to forward. So yes, that's what I said. So this will be special purpose. So I would issue, generally in those cases we issue a special purpose financial statement reports. Where we, again as I said, the standard, the essays are giving detailed templates that how do you report those, entities.
What about AIFs? Alternate investment funds?
So this will be applicable if there is no specific template prescribed by the agencies or authorities where they are registered.
AIFs are regulated by SEBI.
So if SEBI is not giving any formats, then this will be applicable because it is a non-corporate entity. And if it is a corporate AIF, assuming, normally they are not, but if it is, then Schedule 3. Trust, I did mention that trust, if the Trust Act is providing any templates, then those will prevail. Otherwise, this.
LLP is an associate of a company, and that company is a subsidiary of the holding company. So, LLP is has to be as per PDS or has to be according to this.
I think that's a topic different. Whether India is applicable to LLP or not, we can discuss it separately. But short answer right now is yes.
As per Index.
For fit for consolidation. So legally that LLP may continue to follow normal AS, but your holding company, if it is under Ind AS, your holding company auditors may ask you fit for consolidation accounts because they would need Ind AS accounts. So typically LLP will maintain two sets of books of accounts, one under normal law and fit for consolidation accounts. LLP has a choice if they want to, but typically none of the LLP will do that.
Choice is there.
I can opt Ind AS framework. Who will stop me if I am an LLP? But I would not, typically. Because income tax and everything will again go into a different level.
And rounding off of the balance sheet is not mandatory.
It is not mandatory in case of non-corporate
In case
entity.
of income tax, they are asking rupees.
Full rupees. So this we did discuss the template for capital account, current account. I believe the same would be applicable for drawings account also if somebody is maintaining a drawing account. So what are the key changes which will impact is movement of capital account? We did discuss. Okay, in case of loans, we'll have to segregate between secured, unsecured. The similar template which we are using for companies, and even for all the terms and conditions also have to be reported as we do for Companies Act. MSME we did discuss. Trade receivables, it is not the way right now what we report the various age buckets. Here, luckily it is only less than 6 months and more than 6 months is what is required for now. But I'm not sure how many SSCs are again maintaining this data. So gathering all this data will be a real big challenge when it comes to audit. Sorry. Contingent liabilities I have not seen so far. We have ever reported in non-corporate entities any contingent liabilities, so those are reportable here as well in this template. Other non-current assets shall be classified into security deposit, bank deposits more than 12 months, others. So I'm sure as far as Companies Act is concerned, we are all aware that normally a fixed deposits we segregate into three things: cash and cash equivalent, more than 12 months, maturity, original maturity less than 3 months, all those things. So all those things will come in roll now, and those reportings have to be done here as well. Investments, we did discuss classification of PP and intangibles movement. Again, we did discuss this. GIT is something which will have to be reported separately. I'm sure so far nobody was reporting GIT separately, but yeah, GIT will have to be reported. Goods in transit will have to be reported separately. Goods in transit typically comes out of your Incoterms, wherein what terms you are selling or buying, it is FOB or CIF. So basis that you'll have to decide whether the risk and rewards have been transferred to you or not. And if yes, then you show those goods in transit in case of purchase, and if not, then goods in transit again in case of sales. So yes, those have to be reported separately. Profit and loss, similar like Companies Act, items 1% of the total revenue or 1 lakh, whichever is higher, those would need a separate disclosure, as we are aware of this. Revenues for operations separately, COGS, I mean this is something I did mention that finance cost, which is interest on partners capital, will have to be shown separately, and they will take a place under finance cost. That is something which one will have to keep in mind. Now, what are the practical challenges which one will come across when we are implementing this guidance note? So, classification of current assets and current liabilities, we did discuss. Related parties, I mean, there was no mechanism so far with the non-corporate entity that how do you disclose how do you identify at first place what are the related party transactions, because so far the focus always was on reporting the transactions which are covered under 48(2)(b). Now this is AS 18, the definition of AS 18 and 48(2)(b) are different, so one will have to keep in mind AS 18 as well while identifying the related party transactions. Typically I have seen related party transactions, people do miss out on reporting for non-monetary transactions. You only look out for transactions which are monetary. But in my view, even non-monetary items will be reported because those are transactions, monetary or otherwise. So, assuming if you have given rent free premise to your subsidiary entity, whether you mention that or no, yes, that would need a mention because it is a transaction. Money received or not is a different thing, but yes, it is still a transaction. So, this is something one should keep in mind when it comes to related party transactions. Contingent liabilities and commitments reporting would be required, as we had been doing so far for companies, similar disclosures. So we did discuss that. Depreciation, we did discuss in detail that additions. One more problem what would create now is, so far when it comes to addition, what we were following is, we used to follow less than 180 days to itna depreciation, more than 180 days to itna depreciation. No, the practice is not wrong. You will have to now again go back to your Companies Act type book, where from the date of addition, number of days or months or whatever is our accounting policies, depreciation will have to be provided accordingly. Partners drawing accounts, we did discuss. Typically one more situation can arise is partners debit balances. How do you report those? Whether those monies are recovered separately, so do you show those as assets or you club under owner's fund? The answer is yes, you club under the owner's fund, because as we discussed earlier, in substance those are partner balances, non-loan balances. There were practices where people used to show that as a separate asset, which I believe is wrong, and however the misusing is in terms of banks. If you see, only the credit balance or the positive balances will be seen, and only those would be taken as a net worth. So, and the moment some X amount is a net worth, I mean, there could be so many implications. So, debit balances will have to be adjusted there and reported under owner's funds only, in my view. Accounting of deferred taxes, we did discuss. Employee benefit liability. Okay, this is one more area where we'll have to really spend time. I'm not sure how so far how many of us have reported or made AS15 applicable to the non-corporate entities. So whether any provisions for gratuities, leave encashments, earned leave, sick leave, whether those were never made or practically in most of the cases those were not made. It will be a very difficult task to convince clients that one may need an actuarial report as well in case of certain level of entities. Of course, it is universally not applicable to all level entities, but at least for large level entities or large size level 1 entities, AS15 is applicable in full. So this is going to again to be a challenge where one need to obtain the actuarial report, provide for provisions or gratuities and leave balances if any. So this is another area where one will have to be keeping in mind. Impairment of trade receivables is another area. I don't know, typically the practice was whatever bad debts, only those were written off straight to the P&L. One will have to look into those receivables if required, maybe create provisions. AS28 is applicable, impairment is applicable. So those areas will have to be re-looked into now practically. All these disclosures when it comes to loan received or loan given, there was never a clear disclosure whether that those were from with related party or from related party. So those disclosures will come into a big way where you have to identify those group entities, related parties, and at each level you have to segregate those balances between from related party or to related party. So this is something again will be a practical challenge. So far we may not have been very specific in terms of checking whether the entity complied with PF law, ESIC law, whether they were doing so or no. But when it comes to AS29, if there was an obligation, you will have to make the provisions. So one will have to be careful because in non-corporate entities typically these kind of payments these kind of registrations generally were not taken. Of course, I'm not saying everyone was not taking, but one will have to be careful on these kind of things also. Typically, a partnership firm, personal expenses, all of us know, so one will have to be careful there, and we'll have to make sure that that is properly reported or routed through capital account, and those are not forming part of P&L. Cash basis of accounting, I will touch this a little later because I will discuss a little more on cash basis of accounting, because there's a technical guide to cash basis of accounting which I'm sure generally all of us must be following, but there are few nuances there which I would want to discuss separately. One important issue which I again foresee when it comes to partnerships for a non-corporate entity is concerned is maintaining the minutes, signing of financials. Now typically so far what we would have seen is only one partner signing. I am not saying all the partners should sign the balance sheet. Ideally I may want, but I'm not saying that is possible. Why I'm raising this point is because what happens is typically when in case of dispute between those two partners, I mean, a lot of things comes on auditors, and actually we have no enough documentation to substantiate the claims of other partners. Because since partnership firm or non-corporate entity is not a regulated entity, they are not maintaining the minutes or who has got what kind of authority. So that is something which is one area which is worrying me now. Of course, this is not a new issue. This was earlier otherwise also. But probably for all practical purposes, what I would recommend is, assuming there are 10 partners and you are taking only 2 partner signatures on the balance sheet, request client to maintain some kind of gist or minutes where some principal decisions have been taken, and probably at least on those minutes or those gist, request client to obtain the signatures of all the partners, that all the partners are in concurrence of these kind of transactions, and then at later date there are no issue arises during that time. So this is one area which I feel is little catchy. One will have to be dealing this very tactfully as well, but yeah, something has to be taken care of. Items debited directly or credited to the partner's capital account, we did discuss that there is a template, we'll have to report it accordingly. Receivable aging is a challenge. MSME classifications will have to be maintained for payables as well, and cash flow statements as we discussed earlier. So coming to cash basis of accounting, generally when we see, the first question comes in mind is whether accounting standards are applicable for the SSCs who are following cash basis of accounting. The answer is yes and no, both. The guidance given is that yes, it is applicable to the extent or specific transaction or the transaction where it can fit into. So assuming there is a fixed assets per crore under cash basis of accounting, do you maintain gross block, net block? Do you provide depreciation? Yes, to that extent AS10 is applicable, but otherwise in principally cash basis of accounting is not applicable, accounting standards are not applicable to cash basis of accounting in general. If the SSC is following cash basis of accounting, that should be coming up categorically in the accounting policy, and also categorically it should be coming up in the audit report. As I said, as a member, we are supposed to ensure the compliance of accounting standard, which generally is applicable to accrual system. So any cash basis of systems, that should be coming part of our audit report. This technical guide gives a guidance that employee benefits should be recorded as and when paid. Borrowing costs same. Lease payment, it says that one has to record or keep a record as per operating or finance lease, whatever is applicable, but record in books as and when paid. So it does says that wherever accounting standards you are applicable, you'll have to maintain data such, but your recording would be as and when those are paid or as and when the money is received. Only one exception which I could find typically was in case of taxes. It says that if you have paid taxes extra, so generally in a common parlance, what I would understand is in case of cash basis of accounting, expenses are recorded for whatever is paid and receipts are recorded as and when received. Now, what do you do in case of taxes? Do you debit the total amount which is paid to P&L because it is paid, or whether you restrict only to the extent of what is for the year, or any excess payment, what do you do? So the guidance says that in case of taxes, you should record only what is due for the current year, and if any extra is paid, then you should park it in the balance sheet. So any excess taxes paid, one should park in the balance sheet. So when we look at non-corporate entities, vis-a-vis corporate entities, are there any relaxations? So yes, there are a few relaxations. Virtual currency reporting, benami property, willful default to a struck-off company, so on and so forth. These kind of reportings are not required when it comes to non-corporate entities. So we move on to a big question, applicability of accounting standards. As we saw, the entities are segregated into 4 categories, level 1, 2, 3, 4. So 1 is large, 2 is medium, 3 is small, 4 is micro. Typically, one would include the entities which are where the securities are listed or in the process of listing. The word uses securities and not only shares. So there could be possibilities that some commercial papers or some other instruments, even in case of non-corporate entities, would go for listing. Hence, these kind of classifications have been considered. Banks and all those things were out. When it comes to monetary threshold, for level 1 or a large entity, the turnover should be more than 250 crores. Level 2 is 50 to 250. Level 3 is what, 10 to 50, and level 4 is less than 10. This is turnover threshold, and as far as borrowing is concerned, more than 50, 10 to 50, 2 to 10, and 2. However, if you are holding a subsidiary of any of the above, then whatever is applicable to your holding a subsidiary, you fall into that criteria. And typically level 2, 3, 4 entities are called as MSME entities. Briefly, I have given only 3 columns. I have not given column 1 for level 1 large entities, because to large entities, all the accounting standards are applicable as is. There is no exemption available to those entities. So I'm trying to identify here that which are the accounting standards which are not applicable to category 2, 3, 4, or which is a medium, small, micro. Cash flow statement is something which is not applicable to 2, 3, 4 level or MSME entities. AS 10, AS 11, there are certain disclosure exemptions which we will go through, what kind of disclosure exemptions they are. AS 13, certain disclosure exemptions for micro. AS 14, 15, certain exemptions which again we will go through. Leases disclosure exemptions. EPS, while it is not applicable to level 2, 3, 4, and it is applicable to level 1. Now I don't know practically how will I calculate EPS for even level 1 entity. When these entities are non-corporate entities, there are no shares. When it comes to EPS, you need number of shares. So while the guidance note says it is applicable to level 1 entities as well, but for all practical purposes, in my view, this may not be applicable. I don't know how to compute EPS in case of non-corporate entities. Consolidated financial statements, it is not applicable in general to SME entities. Level 1, yes. Again, for all practical purpose, CFS are generally not prepared by each of those entities. But what guidance note says that in case if they prepare for some reason, then AS 21 will be applicable as is to all of these entities. So if some entity is preparing CFS for some specific purpose or for some specific reason, then it will be applicable to them. Deferred tax, accounting for taxes on income, there is good exemption as far as micro entities is concerned. It says that for micro entities, while AS 22 is applicable, it is applicable only to the extent of current tax, and no deferred tax is required to be calculated as far as micro entity is concerned. So a relief to some extent. AS 23, 25, 27, as I discussed for AS 21, that if they are preparing their interim financials or consolidations for investment and so on and so forth, then these are applicable to the respective entities. So this is the table of accounting standards which is applicable to each of those entities. If you just see summary, large entities, all standards applicable, medium enterprises, fully applicable 16, not applicable 7, and with disclosure exemptions 4, for small 12, 9, 6, and for micro, fully applicable is only 8. Not applicable is 11, and exemption disclosures are for approximately 8 entities. This we discussed. Okay. So what are the exemptions or relaxations in case of, I would not pick up all but few important which are useful in day-to-day life that I will pick up. So in case of PPE or in case of fixed assets, there is also a disclosure requirement as if the assets are temporarily idle, or the assets or the values of the assets which are fully depreciated, or the assets which are held for sale. Now all those information which are required in general for all the entities in AS 10, for these kind of entities, these specific disclosures are not required. One of the specific requirement when it comes to AS 11 was that any exchange gain loss should be separately disclosed in P&L for certain class of entities. If you refer the chart earlier, this is not required in those entities. So there is a possibility, or there is a way people used to account exchange gain loss. I have seen exchange gain loss will be either adjusted in purchases if it is on the import side, or adjusted in the sales if it is on the export side. Because what business would argue is, मैंने तो जब price quote किया था तो मैंने तो exchange fluctuation को दिमाग में रख के किया था. So my revenue operation should be higher. or my purchases should be higher or lower considering the exchange risk or no. So though somebody may be following these kind of accounting policies, typically AS 11 wanted the specific disclosures and what are the total exchange gain losses wherever adjusted should be reported or given disclosure. Those kind of disclosures are not required in certain class of entities. And exchange differences which are adjusted in fixed assets. By virtue of AS 11, para 46 and 46A, which allows you to adjust your gross blocks or value of fixed asset under certain circumstances. So those differences, if any adjustment to fixed assets, those disclosures are again not required for certain class of entities. As far as investment disclosure is concerned, there is an exemption if certain statutes are requesting not to disclose certain transactions or certain items, then one has got an exemption that those will not be required to be disclosed here. Employee benefit, there are huge line of disclosures. So there are exceptions to certain class of entities. One important exception which I would like to highlight in case of employee benefits is, in general, this actual valuation or this present value calculations or discounting calculations are in general mandated to all the entities. However, if I believe it is for small and micro. So if the entity is small and micro, then in that case, you need not go with the actual valuation which uses the different methodology to calculate. In that case, you can derive, of course, calculation of liability, there is no exemption. It is just that method of calculating the liability which uses present values or which uses discount rate to calculate your liability, those is not required. So if there is some logical or rational way where you can compute the liability, then you have an exemption. One can calculate accordingly and put the liability in the balance sheet and don't go with the actual valuation. So this is something which one should keep in mind when it comes to AS 15.
The Gratuity Act is not applicable.
No, it would still be applicable. Historically, what had been you doing? So not necessarily that Gratuity Act is applicable. Historically, you have been giving gratuity to all your employees. So by tradition, you are giving gratuity to your employees. So in that case, I would still feel that it is applicable. AS 15 is applicable and allows you to do all the provisioning and all the necessary calculations wherever required.
Certain entities, they say they follow cash basis of
Not acceptable. As I said, accounting standard, you'll have to qualify. That is the only way out. Because accounting standard says you have to make provision.
But in India, there are two formats. For NBFCs, AMCs, there is a different format. In that case, there are also for non-corporate.
No. So I will come to, I think something is coming in the coming slides. So while you are preparing these financial statements, and if you are an MSME, and if you have availed any exemptions of reporting which are available to you, you or rather SSC will have to categorically say in their financial statements first that whether they are large entity, MSME, MSME or whatever they are. This is one specific requirement of this guidance. No? Plus whatever exemptions or optional or mandatory or whatever they have opted, even those have to be reported. So whatever exemptions one SSC would have claimed, those have to be clearly coming out from your notes to accounts or your financial statements.
Turnover figure is being revised for SME. So how will
So that is not applicable. You'll have to stick to this. So typically the turnover limits which we understand from that MSME ministry, no. So it is this guidance note defines what kind of classification. Leases held a lot of disclosures in general in the books of lessee, in the books of lessor, if you are a finance lease or if there is an operating lease. So otherwise, if these was to be applied, there are a lot of disclosures which are required. However, for MSME entities, there are a lot of exemptions given in terms of calculating, first of all, that calculation of present value of lease, all those exemptions also are there in case of finance lease, and presentation of 1 to 5 years, 5 years and above, 0 less than 5 years, all those categorical discussions disclosures when it comes to leases are concerned, there is an exemption provided for small entities. So again, those are listed here. But typically, if one has to report for AS 19, generally 2 pages note is what generally goes as far as disclosure is concerned. So those MSME entities will have a benefit of not disclosing those disclosures which are listed here. Deferred tax, we did discuss that for micro entities, it is only about current tax and they need not calculate deferred tax. So that big relief is there. Certain minor disclosures under intangible assets one may not give. Impairment of assets, there are some exemption available. Generally, for impairment of assets, when one calculates value in use, you actually calculate present value, you do a lot of discounting, you make DCF calculations. For MSME entities, that is not mandatory. One may still do the impairment testing, but for calculation of value in use, those present values and discount rates and all those things may not be used, and one can use a normal or some rational or some logical way to decide whether certain assets are required to be impaired or not. There is no exemption as far as impairment testing is concerned, but methodology, that how do you calculate value in use, that exemption is there for small entities. And then certain minor disclosures as far as 29 is concerned, you need not disclose. We did discuss that if one MSME avails exemption and relaxation, it should disclose by way of note in financial statements following the fact that entity is MSME, level of MSME, which are the standards applicable and which are the standards which are relaxations or exemptions are obtained. The important question is, if entity was MSME in previous years but no longer qualifies in current year, then what happens? Meaning, in year 1 I was an MSME, year 2 I become a large entity or a level 1 entity. Then what? I think the principal question here is whether do I restate my previous year's financial statements, meaning whether my previous year financial numbers will change because that time I had accounted everything as an MSME and now I'm a large entity where some calculations may go under change. We discussed one impairment testing ka number, we discussed one AS15 ka number. What do you do in that case? The answer is no, you did not restate your previous year numbers. You had done right at that point of time because at that point of time you were an MSME, not a large entity. So the correct accounting was followed that time and there is no need to change previous year figure. The next question immediately come up in mind is, if I was a large entity in year 1 and year 2, if I become an MSME, then what happens? The answer is, for 2 years continuously you have to be an MSME to follow the regulations of MSME and not large. Meaning, in continuous 2 years one has to be a non-MSME. So assuming year 1 you are large, year 2 if you are MSME, you still will have to apply all the policies or all the standards which are applicable to a large entity and not MSME entity. So it will continue for next 2 years, meaning in total for 3 years you'll have to comply with large entity. Then only you get an opportunity to shift to MSME compliance.
So this means once you convert it into large support, so you will not restate the previous year figure in mismatch.
So you will have to categorically disclose that there may be some differences in previous years because earlier year I was an MSME and not large. But you need not restate it.
So investments will have to be fair value or it will be at cost?
We are in AS. There is no concept in AS for fair value. We are not in Ind AS. AS says investments are valued at cost or NRV in realized value in case of current, and in case of long-term investments you will have to test for permanent diminution. So that is the principle you will follow. So there is no concept of fair value as far as AS 13 is concerned. So there were few questions which I had identified whether each company entity, non-company entity is required to comply with accounting standards issued by ICAI. We did discuss, yes, depending on the level of entity, one will have to see what kind of exemptions are available, but yes, it is mandatory. Can entity follow voluntary standard accounting standards on voluntary basis? The answer is yes, as we discussed again earlier, that yes, one can do better compliance or better governance, but that option is available. But one will have to keep in mind whatever we are availing, whatever exemptions we are availing or not availing, those have to be disclosed separately, properly in the institute accounts. Whether this classification criteria is applicable to non-company entities who may be required to follow Ind AS, we did discuss that this is not applicable to Ind AS entities. Can an MSME entity choose to avail only one or only some exemptions, relaxations? Yes, we again did that, discussed that. Is accounting standards applicable in case of charitable or religious organizations? Yes, to the extent if there are commercial activities in that charitable institution, the accounting standards are applicable, because the preface to accounting standards says that this is applicable to commercial transactions. So any commercial transactions, activities, accounting standards will be applicable, even though it is a religious trust or charitable trust. What is authority attached to model non-financial statements? We did discuss, though there is no legal authority, but as a member institute has issued this, and for non-corporate entities, yes, there will be an argument whether these accounting standards are applicable to them or not. But as a member, we'll have to ensure that we comply. If the entity was covered in MSME previously, but now it has been transited to large, or in such case, what are the disclosure obligations? We did discuss both sides, that if somebody was large, then what happens, or if somebody was MSME, then what happens. Who can use the model financial statements provided in the publication? An entity which is a non-corporate entity, they can use, or entities where there is no prescribed in any law which they are registered, they can definitely use this model statement. Disclosure requirement: if the entity turnover reduces and ceases to be that level of entity, we did discuss. Whether non-corporate entity is required to prepare consolidated or interim financial statements, this again we discussed that generally the answer is no, but if somebody chooses to do those, then all the compliances which are required for those respective accounting standards will be applicable. What depreciation rates can a non-corporate entity use for preparation of books of accounts, or can the rates differ from Income Tax Act? Again, we discussed this question. What is the duty of an auditor in case of financial statements prepared on basis other than accrual, which is say cash or otherwise? So we again discussed this question, that if it is cash, then we'll have to report this in our audit report, that these accounts are not based on the accrual system, which otherwise a standard would require for. Who can use the cash accounting system? Typically, as per the framework, everyone has to follow accrual system of accounting. But yes, if somebody is still using the cash accounting system, then the necessary disclosures have to be made. Whether UDIN is required? Yes, definitely. We all know the UDIN is required. Is tax auditor required to comply with accounting standards while carrying out tax audit of non-corporate entities? Yes, because we are issuing true and fairness in case of Form 3CB. So, and as we discussed, as a member, accounting standards are applicable to us. So any non-compliance therein will have to be reported. So this was a little brief on financial statements of non-corporate entities vis-a-vis applicability of accounting standards. Any specific questions on this?
Sir, since there is no governing law for this non-corporate entity and as a guidance node, we as a members have to follow it. If the client does not agree to undertake all these things,
I think so. Practically, the only choice left with us is to report in our audit report. I think that is the only choice.
you can simply state in our audit report that as per the guidance node it is there, but the client is not.
Yes, that is the practical choice.
But does that affect
Somebody may take a tough call by not doing audit of that as entity as well, but one will have to be little practical
But
as
does
well.
that affect the true and fair view? And
Definitely yes. Definitely yes. Because the accounting standard framework, which says that certain transactions have to be recorded in particular way, say accrual or say provisioning of employee benefits or say provisioning of some other items or say provisioning of employment. Now if those accounts are not made that way, definitely accounts are not true and fair. So what are those accounts in general then? Then those accounts are typically accounts which are maintaining a hybrid system of accounting, not completely accrual, not completely cash, and hybrid system is not permissible anyway.
No, not as a hybrid system, but let's say they have reported as an existing pattern, not a hybrid system, proper accrual system. Now the point is that the client and all this are the institute is regulating.
Yeah, they will argue. They will very much argue. I'm telling you this. They will be very much arguing. But as a member, as an auditor, I don't see any choice than reporting this in audit report. That this is not complied with.
No, we can report it as a qualification, but does that impact the true and fair?
No, that may depend on the materiality of non-complying of certain transactions. So, I'll just take an example, AS 15. Now, if there was a 1 crore liability which was supposed to be provided as per AS 15, which is not provided, probably true and fair affected. But if it was only 5,000, probably true and fair not affected. So, true and fair testing will have to be done based on SA 700. So that testing remains. At least to see what are the taxes on the business. So while I understand the person may have income from other sources, house property, so on and so forth, but it will definitely have business income as well. And one of the component of taxable income is business income. So maybe you'll have to carve out some number from there, or maybe give some disclosure that this is total tax payable. But yeah, provision for taxes is required. Yeah, there could be so many permutations, combinations there. But this is a practical challenge. This is a practical challenge. So can we skip to the next part? So let's quickly look into the commonly found non-compliances of CARO. Now, before we really jump on to the presentation, or rather, there is actually no point in jumping onto the presentation as well. What I can do is I can summarize this in a couple of minutes. And for all the case studies which are listed here, in general, what I have observed, or rather what FRRB has observed, that we as an auditor have tendency or habit of writing as per information given, as per explanation provided by the management, as relied by the data shared by the management. Now, those kind of generic statements are not appreciated by the FRRB. What they say is CARO is a factual question answer. Whatever questions are asked, specific answers to those questions have to be given. Now, when you look at the observation listed in the presentation, I will share a few things, like what kind of observations they are really making. Now, there is a paragraph, or there are questions on statutory dues reporting. Now, those are specific dues which are listed. Say, for example, it says PF, ESIC, VAT, cess, service tax, GST. There are reportings where auditors have missed to use that word, say VAT or say cess. They have reported all statutory liabilities except VAT. Now, that has been observed by FRRB that this is not correct. Some auditors have reported in general all the statutory liabilities are discharged within the within the time frame. Now the word in general. Now these, what FRRB says, that these kind of statements in general, as per information given by the management, this is giving a very different kind of perception for the readers, where it says that you have not performed your duty as an auditor, where you have not performed enough audit procedures, and hence you are reporting as discussed or as shared by the management or as information as per information provided. So in general, what FRRB is saying is that these kind of generic statements are not good for the purpose of reporting. One should report very specific to the question, because CARO is a specific question answer statement. Another example, what they had observed in case of fraud. Now auditor had reported that material frauds were not done. Now if you read the language of CARO, it talks of any fraud. It does not say significant fraud, material fraud, non-material fraud. The FRRB has observed that no, this is not right. One has to look at material, all frauds and not material fraud. Loans. People talk of only investment. The CARO requires investment, securities, guarantees. All those paragraphs are skipped. There are no comments on comment on loan, no comment on investment, guarantees, securities. Those are again observed by the CARO, by the FRRB. FRRB has gone to an extent that in one of the CARO report, it was said that no investments are made and there is a compliance of section 186. But in balance sheet, there were investments. There are loan givens. Now, this is the background, or this is the thought process with FRRB, that when they look at these financial statements, the perception what auditors are creating is that they have not fulfilled their audit procedures or audit duties right. This is in general summarized submission for this whole of the presentation. Let me just quickly give a couple of more minutes. I will just quickly run through if there are any specific things which I would want to highlight. Okay, in one of the cases, in CARO, it was mentioned that non-compliances are as per annexure given below. No annexure given below. Non-compliances, there is a specific requirement in case of CARO, where if something is not complied, you have to give the details in particular table, in particular form. Those are not given. And mind you, all these are listed companies. All these are listed companies, all these are listed by Big Four. I mean, good audit firms. Still, these kind of observations are made by FRRB. In one of the case, auditor had mentioned that there is a compliance of AS 18. However, the entity was under Ind AS framework and not AS framework for related party transactions. So again, the idea was that somebody would have copy-pasted the earlier report and use that. So the point here is that when we are making CARO or we are reporting in CARO, please look at the question specific, what is asked, and report accordingly, because the major observations are such that what is asked is not reported or reported in a language which is very generic, which does not observe the auditor's duty. So this is the summary or substance of this presentation. Let me see quickly if there are some specific points which I would want to discuss. So this was about this general statements. So in case of immovable properties, if the title deeds are not in the name of the SSE, then you have to give which property, where, and so on and so forth. That was missed. It was simply said that there are certain immovable properties where the title deeds are not in the name of the company. PP physical verification talks of reasonable interval. There was no comment on whether the verification was at reasonable interval or no. So those are again observed. This was nice. Physical verification of inventory. The auditor had mentioned that verification of inventory at reasonable intervals during the year, wherever possible and required. Now this was again observed by the FRRB. What can be wherever possible and required as far as inventory is concerned, inventory verification is concerned? For loans, it was reported for certain term exceeding so and so. But as far as CARO is concerned, there is no specific term. There is a compliance or not compliance. Why are auditors going to a periodicity compliance or not? So those kind of observations were there. In fact, in CARO, one of the auditors has reported that auditors have relied on the management representation. If you see these lines. So these kind of disclosures are not seen in a good light by FRRB. So it was said company has complied with the provision of section 185 and 186. However, it was observed from the financial that company has neither granted loan nor does it has any investments. Security we discussed. Again, investment under section 186. Typically, this section gives certain relaxations to infrastructure companies, wherein if there is some infrastructure company, and if you give loans, then you have exemptions or certain exceptions. Those was not coming out of the CARO very clearly. This was this observation. Statutory dues, we did discuss that auditors are missing those few dues or saying in general as statutory dues. Again, statutory dues, if you see no material dues. CARO does not restrict on material, non-material, so any dues have to be reported. That again is not seen in a good light by FRRB. There was no reporting as far as contingent liabilities for statutory disputes was concerned, but the balance sheet was showing a lot of various contingent liabilities, which again was observed. Typically, this clause. So, generally, this clause starts with whether money raised, IPO, further allotment kind of thing. I don't know how much vigilant we are that it also says and term loans. तो जो and term loans पीछे भूल जाते हैं हम पहले IPO, further allotment कुछ नहीं है छोड़ दिया. But there are a lot of term loans borrowed during the year and reporting are getting skipped there. Fraud, we did discuss material fraud. Okay, so the way it was reported that the auditors have not identified any noticed or reported any fraud during the course of audit. Now, what does this represent? When they were doing audit during that period, the fraud was not detected. But the fact is, the fraud has to be identified for the year for which the audit was done and not during the period when you were doing audit. So these kind of reportings have happened in a lot of entities where FRRB is observing. AS 18 and AS 20, Ind AS 24 is what we discussed. Yeah, I think I had covered this in summary what this whole presentation was about. Any questions here on, or maybe on the earlier presentation as well? All right, thank you.
Thank you, Yogesh, for a detailed presentation. And now I request my ex-convener, CA Nilesh, to propose a well-hearty vote of thanks.
Thank you, friends. Thank you, Vipul Bhai, for giving me the opportunity. First of all, we also acknowledge the presence of our next speaker, CA Pankaj Shah. Thank you very much, sir. what we understand that normally for a corporate scenario, we have lots of rules and regulations and we follow everything. For a non-corporate scenario, we are not used to all these compliances. So definitely there will be practical problems, and the solutions is 100% not available as of now. But yes, we have to follow accordingly, and maybe the system is thinking that it will rise to the corporate level compliances in future for non-corporate compliances also. Thank you, Yogesh sir, for your nice presentation and giving your valuable time for a study circle. I, on behalf of Borivali Study Circle, propose a well-deserved vote of thanks with a loud round of applause. Thank you, friend. And as usual, we have a break for 5 minutes, which runs for